Well, hello and welcome to Finspire's Focus on the Markets series, second quarter 2021 edition. The theme here you can see is road trips and bacon, and you'll understand why as we move along today. I'm Karam, Chief Investment Officer with Finspire. I recently returned from a spring break road trip and took the family. I've got 3 kids. My wife and 3 kids went down to Florida for break in March, and it reminded me of the Jeep Wagoneer, which is what you see here, a picture here on the right, which is actually a 1988 Jeep Wagoneer. Jeep is actually relaunching its famous Jeep Wagoneer brand later this year in a much more updated and comfortable style. But as my 9-year-old was going through the road trip and wondering and asking that particular question, are we there yet? It reminded me of back in the 1980s in our family truckster, known as the Buick Electra, that as I was in the back seat, as I was the youngest of 3 kids, clamoring to get there sooner. And this came after, of course, 15 minutes of a 15-hour car ride. So it was exciting for Jeep that they're bringing this back. It gave me quite a nostalgic moment as I was traveling down to Florida and back from Florida back in March. And we'll get to the bacon part in a little bit because you'll understand more about that when we talk a little bit more about the inflation story and some news that hit over the weekend. So as we get to, let's start with the overall capital markets with the economy. The economy is doing extremely well, as indicated by both manufacturing activity, which has reached heights that we haven't seen in well over 20 years, and also non-manufacturing or the service sector, which also correspondingly is doing quite well with not only the fourth quarter inventory rebuild that began, but we've seen that continue right through the first quarter of 2021. It's safe to say that the economic rebound is going very well and is at a very strong point right now. We also see that not just with manufacturing and non-manufacturing activity, but that activity needs to remain high because our ability to spend as consumers remains very, very strong. Retail sales growth at 6.3% is still above the historical average of about 4.2%, but non-store, meaning Amazon and other e-commerce sites like Walmart.com, et cetera, are experiencing really record growth in retail sales figures through the e-commerce websites to the tune of almost 26% growth. And we need that manufacturing activity to keep pace and refill that inventory that's being consumed by U.S. citizens. This is also a good sign because this is creating jobs again in the economy. Right now, as of the end of January, there was almost 7 million job openings in the marketplace. This on the heels really precedes an excellent jobs report that we received reflecting March data that came in early April. It actually was released on Good Friday, but that jobs report was stellar. It showed that the unemployment rate dropped to 6.0%, and it showed that we added over 960,000 jobs in the month of March. So the jobs picture is getting better, especially as more and more people have recovered from COVID and have been vaccinated, and it's paving the way towards a formal reopening of the U.S. economy, perhaps sooner than what was originally forecast. This type of economic good news has yielded a continued strength in global equity markets. We saw the rally continue with small caps rising 18% in the first quarter. Commodity prices, which were up 7%. We'll talk more about that in a little bit. The S&P 500 up 6%. International equities were also higher. Diversified portfolios were up around 3% for the first quarter of 2021. The one blemish was on the fixed income area, where we had a negative 3% return on the Barclays aggregate U.S. aggregate bond index, and that's due to interest rates rising. And so we'll talk more about the interest rate story in a moment. Interesting point in time when we do year-over-year comparisons of returns. In essence, these aren't misprints. These are something you do want to, however, take a second glance at, because with year over year, March 31st, 2021 versus March 31st, 2020, with the equity markets bottoming out in the first quarter around March 23rd of 2020 last year, we're now seeing year-over-year comparisons be quite extraordinary. Small caps up over 100%, mid caps almost 90%, S&P 500 up 57%. These are not typical returns of any particular 12-month period. It just so happens that when we do a look back over March 31st over 12 months, it reflects almost the trough or the bottom of the markets that occurred in the first quarter of last year. Now, what does that mean? That means our valuations are significantly higher than where they were a year ago. And almost any way you slice it, whether it's through price to earnings multiples, price to book ratios, price to sales, price to cash flow or dividend yield, stock market valuations are certainly at an elevated level. And if you look at the most commonly used stock market valuation metric, which is price to earnings ratio, that's just simply the price of the company relative to the earnings that are created or generated by that company. We do see, however, that denominator, which are earnings, starting to rise quite sharply. And so this is why, although valuations remain somewhat elevated, it is possible with an improved denominator or improved earnings levels and earnings on the rise that these could support these higher levels, higher asset prices. And that's something that we can expect. We can expect, just like year over year in the equity markets from March 31st, 2021 versus March 31st, 2020, that asset prices are higher. We can also look at year over year earnings growth as being substantially higher over that time period as well. This is also reflective of a rotating equity market. So in 2020, 2020 was a very technology-driven equity market, which really fueled the broader S&P higher. We're now seeing other sectors, such as the energy sector and the financial sector, push higher. So first quarter returns in the energy sector, for example, were 29.3% relative to technology at 1.7%. So not only is the market as a whole continuing to rise higher, but we're starting to see a rotation occur with different sectors being more in favor this year versus last. Okay, areas of concern when we look out over the intermediate to long term. The first and foremost is the budget deficit. Last year, the government in its fiscal year ending September 30th recorded a over $3 trillion budget deficit as COVID relief measures like the CARES Act tallied to about 4 different bills from Congress that worked their way through Congress. And that equated to a 15% of GDP. Budget deficit is 15% of the overall GDP. And those are numbers we haven't seen since World War II. So that's how substantial that over $3 trillion deficit the government ran as September 30th, 2020 was. But the intriguing part is what's going to happen in 2021. So when we flash forward to September 30th of 2021, it looks like we're headed there again for another $3+ trillion budget deficit. And that really has a few areas of concern, creating a few areas of concern, one of which, although is you would expect with a rising budget deficit, is you'd have a weaker currency, right? And because there are fears about things such as inflation. So what we're looking at here is actually producer price inflation, not consumer price inflation. So one of the more common metrics of inflation is something called the Consumer Price Index, which is a measure of what we pay as consumers for different goods and services. Well, what's interesting is that producer prices, as you can see here, have been rising substantially since the end of 2020. Whether you look at somewhere between 2.5% to 2.8% growth, and that's compared to what consumers have been paying for goods in terms of inflation has been closer to about 1.5%. So there's a big difference between what producers are paying and what consumers are paying. And that's why there's this expectation that eventually it's going to hit the consumer's pocketbook because producers are paying more for the goods to create and manufacture the goods and services in the economy. What this also has done is pushed yields higher. So naturally, if you have concerns about higher inflation, the government has to auction off their Treasury bonds at interest rates and yields that are substantially higher than they were a quarter ago or a year ago. And that's precisely what's happening today. You can see the 10-year yield at the end of March was 1.74% versus 1.08% a quarter ago and 0.76% a year ago. This is a common occurrence when you see the economy doing better and you see inflation concerns creep in the system. In essence, yields have to rise in order for them to be an attractive investment to global investors. So this also ties in with our story about bacon. And I'm going to finish with this because with that concern about inflation, we received news over the weekend from Business Insider that there could be a concern, and you can expect to pay more for hot dogs and bacon due to a supply chain shortage of hogs in the marketplace. So that's how inflation can impact us in the real world. It can impact us through supply shortages. It can also impact with a growing demand for services, especially as we approach the summer season where we enjoy our barbecues and our bacon on special days like Memorial Day, July 4th, and Labor Day upcoming this summer. To learn more, we want to thank you for joining us today. To learn more about what we're all about at Finspire and some of our other previous commentaries that we've posted, feel free to visit us on our website at finspireme.com. You can visit us and connect with us over LinkedIn to search for Finspire, and our YouTube channel, where this video and others are posted to the Finspire channel on YouTube. Thanks again for joining us, and we'll talk to you next quarter.